In the last year, GameStop stock is up about 15x, which is pretty incredible when you think about a company, a retailer, mind you, that's generally viewed as a melting ice cube. Today alone, it was up over 50%. That is some incredible price action. 15x over a year, 50% in one day. Most of that 15x has happened in the last few weeks. How is it possible for you to get that sort of crazy price dynamics in just a few weeks and 50% in one day? Today, I'm going to talk about the mechanics of that price movement. I'm not going to focus on the fundamentals of GameStop. And honestly, there's actually a lot going on with GameStop as they're trying to, expand some e-commerce initiatives. They're facing the impact of COVID. At one point, Michael Burry had bought shares. Michael Burry is famous for being a super deep value investor who actually, really made most of his money supposedly with the Big Short. And that's where it was this huge home run for him, where he was shorting all the subprime, and he had, he was using these derivatives that went crazy. Michael Lewis wrote a great book about it right here, The Big Short. Highly entertaining, and you've probably seen the movie. The book's even better. And so he bought shares of GameStop fairly a few months ago, and then very recently a short seller report came out. So there's a lot of moving pieces to the GameStop thesis. And since the short report came out, they've gotten totally torched, and unfortunately there have been bad actors as well, like threatening the short seller who's saying a lower price target. So it's getting nasty out there, and honestly, I'm not interested in going into the GameStop fundamentals because actually my journey generally is focused on long-term compounders. Regular viewers know I'm looking for potential multi-baggers that I'm confident will grow, with the fundamentals of a business long term, where you're saying, hey, this company's unrivaled, hence the name of the channel. You have an unrivaled value proposition, and you're going to take share over time. And that's, look, if you go to unrivaledinvesting.com, click on Journey, you can see what are those types of companies that I'm buying that I say, oh, this company is special, and I think they could potentially be taking market share over time. Each month you can see an update of my portfolio, and each month I have a call out of what's the monthly potential multi-bagger that I'm calling out, where I think, hey, it has several 100% upside, but it's based on fundamentals of like what's actually going to drive that longer term. Whereas here, I'm actually not focusing on what's driving GameStop's fundamentals. I'm not focusing on the fundamentals in this video. Today, I'm actually focusing on the mechanics, and particularly how can option trading lead to the price action that you've seen today, particularly with GameStop stock, where it was up over, at one point it was like 70% today, so it ended up being only up 50% today, where it went from $42 a share at the open to at a high of 76 a share during the day. So what is going on? How do you think about these mechanics, these pricing dynamics? So first, if you're not familiar with short squeezes, and that's what's going on, let's take a step back to sort of explain the mechanics step by step. So first of all, there's many ways for a transaction when you're buying and selling a stock to go through. There's traditional, just buy a stock. That's the bread and butter, and you can do just fine doing that longer term. Maybe I'm dating myself by that, of just saying, hey, just buy shares in the stock. You buy a stock, and there's someone that owns the stock, and they sell it to you. That's the end of the transaction. Then the next, another type of transaction is a short sale, where you're interested in buying it, and then the seller doesn't actually own the shares. The seller goes, you know what? I think this price that they're interested in buying at, I think it's overvalued. So I'm going to borrow the shares from someone else and short sale them to you. And my goal is to buy them back in the future at a lower price. Hence, I make money if the stock price goes down, because I'm borrowing the shares now, I'm selling them to you at the current price. If the price goes down, I can buy them back and, sort of make a spread there. Now, I will have to pay interest on the shares of the dollar amount and the supply demand scarcity aspect of whatever interest rate is being charged on those borrowed shares. But that is one approach. Now, I personally generally don't short specific company stocks. Indices are another thing, but focusing on individual company names, because you have this type of risk of things going parabolic and sort of blowing up in your face. It's very, the risks reward are very asymmetric with short selling in general, where when you're shorting a stock, the upside that you can get is 100%, where, hey, if the stock drops 100%, you've made 100%. That's it. That's how much money you can make as a short seller. Whereas the losses are potentially infinite if the stock just keeps going higher and higher. And that's the danger with short selling. Another aspect, so let's make this even more complicated, is with options. And this is where the current market is sort of going on steroids and taking it to another level, like kicking it up a notch in terms of speculative fervor, where what you're looking at with options, particularly call options, is call options give you the right to buy stock at a set price. So for example, if the shares, and GameStop was previously trading at like $4 a share a year ago, let's say you were to say, you know what, I think GameStop has a lot of potential and the stock price could really run. So I'm going to say, let's buy the right to buy shares at $10 or $12 a share. But it's only trading at $4 or $5 a share now. So who in the right mind, you'd say, would want to buy at $10 or $12 a share? Well, it's someone that's saying, hey, I'm taking a speculative bet. It's a long bet. It may not work out. But if it works out, then I get the right to buy those shares at $10 to $12. And it might only cost me pennies on the dollar. So I'm saying, hey, this is a call option. Maybe it's a few months out. And I'm saying, I'd like this. Let's say the shares are at $4 or $5. I'd like to buy the stock at $10 a share, but the cost for me to do this transaction is only 5 cents per share. And that's how it's structured, and options are generally in blocks of 100 shares. So that gives you a lot more buying power if you want to take a crazy speculative bet where you say, you know what, I could only buy, let's say, $1,000. I have $1,000 worth of capital that I can play around with, and I could put it all in GameStop stock, or I can get like 20 times my buying power if I were to put it into these call options, or 100 times my buying power if I put it into call options that are trading for like 5 cents or 10 cents. If the stock's at $5, maybe I could get these options for 5 cents. And it's really like, hey, if the stock price goes to 15 and I have the right to buy it at 10, so really my all-in cost is 10.05, I can make crazy amounts of money because I'm buying the right to so many more shares than what I could buy if I were just buying it outright. The challenge here is that with options, and this is also one of the aspects that I don't like with options, and I only use options strategically with my own investment portfolio. And what I don't like about options is that it's, for the most part, a zero-sum game. Go back to the first situation. When you buy a stock from a natural seller, they own the shares and they're selling them to you. Hopefully they're like, you know what, I made some money, I'm done with this story. I'm either retiring or I want to put my money in something else. They sell it to you. The stock goes up, you've bought the stock, it goes up. Now you make money. That is an additive sum game. Those are the types of games that I want to play, where everyone can still win. So the seller, they could have won, they could have owned a stock as it's gone up. Like, for example, if let's say the seller, let's say you're buying shares of some really great company that's gone up a lot since its IPO, and you're buying the shares from the person who was one of the founders. And so they've made a ton of money. Well, you know what? Maybe they're looking just to get cash out, and you're looking to capture that ride going forward. That can be a win-win transaction. They want the cash to retire, and you want the money. You want to participate on the journey going forward and make money that way. So that is the reason why I prefer just buying stocks outright, because it's not a zero-sum game. It's additive. With call options, it is a zero-sum game, because when you're looking at, let's say, going back to GameStop, you're buying those options, to buy shares at $10 a share at 5 cents. And this is going back, several months, or 10 cents, or whatever it was. You're effectively, in order to execute that contract, someone else has to say, oh yeah, I'll definitely sell that option to you. I'll sell you that right. such that I will deliver those shares to you if you want to buy them at $10 a share. And keep in mind, it's $5 right now. I have no problem with the idea of you buying these shares from me at $10 a share. If it gets closer to $10, I'll buy those shares. In that scenario, just the same as the short seller, the person who's selling those call options, they're going to be a buyer at some point. They might become a forced buyer if the price starts going higher and higher and they go, oh man, I don't want this exposure. For example, and there's been a lot of people that have been making these bets, and you can go onto online forums on Reddit. There's Wall Street Bets, and there's a lot of focus here on GameStop, where one particular user, Deep Effin' Value, I'm not saying the exact name, I'm trying to keep it clean for this channel. He bet something like 200 grand all in. Maybe it's less than that, maybe it's sub 100 grand over the last year. Almost all of his portfolio, and it's labeled YOLO, you only live once, on GameStop options and stock. And now his portfolio, and he posts screenshots, he or she posts screenshots of their portfolio going from 100 grand to now over 11 million. I think it may have been like 12, 13 million. So that's the type of story that gets people like, holy smokes, like that is a lot of money. And that is the YOLO bet. Like, you only live once, let's make a bet that really counts. Like going from $50,000 or $100,000 to 10 million, 11, 13 million dollars, all on GameStop. And that's the part that's getting people hyped up. But it's worthwhile to understand the dynamics of like what's driving the price action. What are the mechanics that's driving that? And it goes back down to how, when you have short sellers and when you have those that are selling those call options to you, and keep in mind, selling call options, that's options period are a zero-sum game. Your gain is another person's loss, with options. And so with these call options, let's say and this is exactly what this Reddit user did, is they're buying a lot of these out of the money call options, a lot. And so maybe you buy call options at $40 a share, way above where it currently trades. And you do enough of that. And then the person who's selling it to you, you're like, yeah, it's not going to get to that price. But what if you have a forum online and you start getting more and more people hyped up about a trade? Regardless of the fundamentals. I'm not talking about the fundamentals. I'm talking about sort of animal spirits here. What's driving this thing? If you get enough people putting in orders to buy those options, then the folks that are selling those options are like, oh man, I don't want all this risk that I'm potentially having, even though, I previously thought it would be ridiculous. The fundamentals do not justify going to this price. I don't want this risk anymore. I don't want this exposure. So they become buyers as well to cover. They're like, I want to get out of this trade where I was selling you the right at $10 or $20 a share. I don't like this anymore. The share price is going up. I thought that was free money. That's the way they thought. If the stock prices was at 5 and they were like, yeah, I'll sell you I'll sell you the right to buy it at 10 for 20 cents or 12, or 10 cents. That's free money. But the reality is, it was just picking pennies up in front of a steamroller. That's what ended up happening here, because they thought they were getting free money, when in reality, you get enough people doing it, and then you combine it. So you get enough people selling these things, like, hey, this is free money. So you get a lot of people doing that. You combine it with this sort of wave of people willing to make speculative bets. And then you have, oh my goodness, I'm willing to have this much exposure. Wow, there's a lot of people interested in this. I don't want this exposure. Oh, now it's going above the exposure I'm willing to do because the price is rising. You get this wave of initial buyers looking to buy the options. And because, keep in mind, they may not have billions of dollars under management, this wave of buying call options, but it's because they're buying call options that they're able to magnify their purchases. Going back to that Reddit user that, very clearly started with a couple of $100 grand, like $100 grand or less, and now is $10 million. That is a huge loss for that respective counterparty, and it's probably gotten traded along the way. But it's either way, that is you're talking about $10 million net loss plus plus greater than $10 million net loss for those counterparties that have been willing to sell it. So as they realize, oh crap, like this exposure is way bigger than I realize, they become forced buyers. So you have the speculative, let's say retail investors that are saying, you only live once, let's make it happen. Then you have the market makers and the hedge funds that manage billions of dollars, and supposedly there's one, like $12 billion fund that's down 15% in large part because of GameStop, where they've made bets saying, hey, this valuation doesn't make sense, I'm willing to short it. But reality, they're getting their face ripped off. They thought, hey, this is free money, but in reality, they're going to become a forced buyer. And that's where you get this short squeeze, is because you have these forced buyers. They're like, oh my goodness, I need to cut this exposure of GameStop stock keep going higher. Like this is eating up my profits, and or it's resulting in this loss that's way beyond what I was willing to do. I need to buy it. And let's say there's no one, there's the normal amount of buyers and sellers, and so you don't have enough sellers willing to match that buying amount. So you create this speculative drive that's a price it's a mechanic thing where your demand side just goes absolutely nuts as they're looking to cover their losses, as they're saying, oh my goodness, like I can't handle these losses, they're too much, get me out of this. They become forced buyers. There's not enough sellers to meet the demand, and then it just goes parabolic. So that's why you see GameStop stock up over 50% today. But like once again, I prefer to play additive sum games in life. I think that'll be a more enjoyable journey longer term. I understand that other people like to play zero sum games, but it's kind of like sitting down at a poker table and saying, hey, I hope we can all make money. That's not the nature of it. The nature is, like, when you're sitting down at a poker table, you should assume everyone there wants to take your money. As a matter of fact, you should assume, like, if you were to leave your chips on the table and walk away, they would take your chips. That's how cutthroat it is. And I honestly think that's how cutthroat option trading is. It's just like the poker table, except multiplied by billions of dollars. And so I'd rather play a game where I feel good about it. Like maybe the seller was like, hey, I wanted to get out for retirement, and I'm buying these shares, and I'm happy that you're owning my piece of this company, and it's going to go up over time. So that's what, honestly, that's what my journey's all about, is let's find these compounders. Let's try to find these unrivaled, these exceptional companies that I'm comfortable owning long-term, where management has buy-in, and we're just watching it grow year by year, and maybe you get some valuation benefit as well. But that's the main focus. So here in this video, I was trying to cover, what's actually driving this crazy pricing dynamic with GameStop. I'm not covering the fundamentals, because primarily I'd argue what's going on now is probably driven mostly off of pricing dynamics, a function of supply and demand of what's available, and sort of getting this overwhelming demand because they had previously sold short, either through selling short directly or selling call options, where now they're like, oh my gosh, this exposure. And that exposure, just to give you some perspective, like that exposure is huge. Like someone is going to have to pay this deep effing value guy who's got made $100,000 bet that's now worth, $12-13 million. Someone's going to have to pay for that. And that's a huge loss. And they're like, what if that turns into a $20 million gain? That's the concern for, whoever is that short seller. You don't want to be picking up pennies in front of a steamroller. And so think about what sort of game you want to be playing as well, longer term. It's all about sustainability. Like how can I make sure my career as an investor is sustainable and doesn't blow up? You know what? I'll create a separate video exclusively for Journey subscribers to talk about that element and how it's so important. But anywho, if you enjoyed this video, learning about sort of these very bizarre pricing dynamics, particularly around short squeezes, make sure you subscribe. Normally I talk about, this is a no hype financial channel. Like normally I'm talking about companies, I'm doing a deep dive, I'm trying to say, are you unrivaled? Do you have 10x potential? Could this be a multi-bagger? In this case, I just thought it was such, you don't see short squeezes every day. So I wanted to call it out just because it is interesting. And occasionally it just leads to just absolute bananas valuation. So it's historical. Like it's just amazing to see. As a market participant, I enjoy watching these dynamics. I don't enjoy the prospect of anyone, getting hurt, which clearly some people have gotten dramatically hurt, as others have made an incredible fortune. It's also just a completely different dynamic now, where you can coordinate effectively these bear raids, where it's like, hey, we're all on this farm, let's all go buy these options that are way out of the money, and force these market makers to be like, no, I don't want this coverage, like. Or these hedge funds like, you know what? No, this is too much. Like there's too many people bidding for this. I just want to buy the shares and get my exposure, close my exposure. So it's really interesting from that perspective. Just as a market observer, if you're interested in my personal journey in terms of what are the potential multi-baggers that I'm looking at, what am I buying each month? Each month I give an update. Go to unraveledinvesting.com, click on Journey. Also below this video, I'll provide a link to all the exclusive content. So if you're interested, you can see what you're getting into. And I hope you enjoyed this video learning about the very bizarre pricing dynamics of a short squeeze with GameStop stock. If you enjoyed it, subscribe. If you're already a subscriber, I appreciate that thumbs up. And thank you so much for watching.